Think about it. We spent years in school learning algebra, memorizing historical dates, writing essays about literature, even dissecting frogs in biology class. But when it comes to managing the thing we all use every single day, money, nothing. No one told us how to handle our first paycheck, how to build credit, how to avoid debt traps, or how to actually grow wealth. And that's why so many people today are stuck living paycheck to paycheck, constantly stressed, drowning in loans, and feeling like financial freedom is only for someone else. Does that sound familiar to you? Have you ever felt like you work hard, but somehow your money disappears before the month even ends? You're not alone. Millions of people feel exactly the same way, not because they're lazy, not because they're not smart, but simply because they were never given the tools to manage money in the first place. The truth is, financial literacy is the foundation of everything when it comes to your future. Without it, money controls you. With it, you control money. And by extension, you control your future. Here's the good news. It doesn't matter how old you are, where you're starting from, or even how much money you make right now. Anyone can learn this. And once you do, your whole perspective on life starts to change. Think about this. What would your life look like if you didn't have to worry about bills every month? What if you could wake up and know your savings are growing, your debts are shrinking, and your money is actually working for you instead of against you? That's exactly what financial literacy gives you, the knowledge and confidence to make money a tool instead of a source of stress. And that's what this series, Financial Literacy from Scratch, is all about. Together, we're going to cover everything step by step. Here's a little preview of what's coming. First, budgeting. Now I know when people hear budget, they imagine cutting out everything fun in life. But that's not what it's about. Budgeting is simply giving your money a plan, so you decide where it goes instead of wondering where it disappeared. Second, saving money. You might be thinking, but I barely make enough to cover my bills. How can I save anything? Trust me, even small amounts matter. I'll show you how to build the habit of saving, even if it's just a few dollars a week. Over time, those small amounts grow into something life-changing. Third, we'll dive into debt and credit. Because let's be honest, credit cards, loans, and debts can either be your best friend or your worst enemy. Most people fall into traps simply because they don't understand how credit really works. By the end of this course, you'll know how to use credit wisely, avoid debt that drags you down, and build a strong credit score that actually helps you. And of course, we'll cover investing. Now don't worry, I'm not going to throw complicated Wall Street jargon at you. We'll keep it simple: stocks, funds, compound interest. The goal is to understand how to make your money grow, even while you sleep. And finally, we'll talk about the mindset of money. Because believe it or not, 80% of financial success isn't about math. It's about habits, discipline, and how you think about money. If you've ever felt guilty spending, or anxious saving, or even avoided checking your bank account, that's mindset at work, and we'll fix that too. Let me ask you, have you ever gotten your paycheck, felt great for a moment, and then 2 weeks later looked at your account wondering, where did it all go? Or maybe you promised yourself this month would be different, that you'd finally save, but somehow nothing changed. That's not because you're bad with money, it's because you were never given the tools. And that's exactly what we're going to change together in this course. So if you've ever felt like money was this big mystery, or that financial freedom was something only rich people could have, this series will prove you wrong. This is the beginning of your financial journey, from zero knowledge to full confidence with money. Are you ready? Ready to finally take control of your money and your future? Because from this moment on, we're not just talking about financial freedom. We're starting the journey together. Let's begin. Chapter 1. Budgeting Basics. The secret formula: how to control your money instead of money controlling you. Let me ask you something. Have you ever looked at your bank account a few days after payday and wondered, where did it all go? You had plans. Maybe you even promised yourself that this month would be different. And yet somehow the money disappeared. If that sounds familiar, you are definitely not alone. In fact, studies show that nearly 60% of people live paycheck to paycheck. But here's the truth, it doesn't have to be that way. There's a simple formula you can use to control your money instead of letting money control you. And that's exactly what we're going to cover in this video. Part 1. Income versus expenses. Let's start with the basics: income and expenses. Sounds obvious, right? But here's the catch. Most people never actually track them. Think of your income as water flowing into a bucket. That's your paycheck, maybe some side hustles, or passive income if you have it. Now, expenses are the holes in that bucket: rent, groceries, bills, subscriptions, dinners out. That random late-night Amazon order. If you never pay attention to the size of those holes, the bucket will always be empty, no matter how much water you pour in. That's why the very first step to financial control is awareness. So here's your challenge. For just 1 month, write down everything you spend. Yes, everything. Coffee, snacks, streaming services, the little things you forget about. You'll be surprised how much leaks out of your bucket without you even noticing. Question for you: if I asked right now, how much did you spend last week on non-essential stuff, could you answer? Most people can't. And that's why money keeps slipping away. Part 2. The 50-30-20 rule. Okay, once you know your income and expenses, the next question is, how do you organize them? That's where the 50-30-20 rule comes in. Here's the formula. 50% of your income goes to needs: housing, utilities, food, transportation. 30% goes to wants: dining out, travel, hobbies, fun. And 20% goes to savings and investments, building your future. Simple, right? But powerful. Let's say you earn $3,000 a month after taxes. According to this rule, $1,500 is for needs, $900 for wants, and $600 for savings. That means every month you're automatically building a safety net and preparing for long-term freedom. Now maybe you're thinking, but I can't save 20%. My expenses are too high. Okay, that's real. Maybe for you it starts with 5% or 10%. That's fine. What matters is not the percentage at first. It's building the habit. Because habits grow. The 50-30-20 rule isn't about being perfect, it's about having a framework. Without a framework, you'll always feel lost. With it, you finally have a roadmap for your money. Part 3. Breaking the paycheck-to-paycheck cycle. Now let's talk about something huge. How to stop living paycheck to paycheck. Here's the secret. Pay yourself first. Most people pay their bills, buy stuff, go out, and then, if there's anything left, they save. Spoiler alert, there's never anything left. Instead, flip the script. The moment your income hits your account, take a percentage, even if it's just 5%, and move it into savings. Automate it if you can. This way, saving becomes non-negotiable, just like paying rent or electricity. Imagine this. If you save $200 every month for 5 years, that's $12,000 plus interest. Now add investing into the mix, and the growth becomes exponential. That's how you build freedom. Not by waiting for extra money, but by making saving the priority. Think about it. If you got a raise tomorrow, would you actually save more? Or would you just increase your lifestyle? For most people, it's lifestyle. But when you pay yourself first, you break that cycle forever. Part 4. Common mistakes beginners make. Before we wrap up, let's cover the biggest mistakes people make when budgeting, not tracking expenses. If you don't measure, you can't manage, only saving what's left. Like I said, there's never anything left. Being too strict. If your budget feels like punishment, you won't stick to it. Balance matters, forgetting irregular expenses. Things like car repairs, gifts, medical bills, they always come up. And if you don't plan for them, they'll wreck your budget. Budgeting isn't about perfection, it's about consistency. If you avoid these mistakes, you'll already be ahead of most people. So here's the takeaway. Budgeting isn't about restricting your life, it's about gaining control. Control over your money, control over your future, control over your freedom. Your challenge this week is simple. Track every expense and try out the 50-30-20 rule. Start small, but start now. Because remember, if you don't tell your money where to go, it will decide for you. And trust me, it won't go where it's best for your future. Now, I want to hear from you. Share your results in the comments. Was it easy, or did you find it challenging? And especially, share any positive changes you noticed. Because your wins can inspire others to take action too. And before you go, make sure you hit that subscribe button and turn on notifications. Because in the next video, we'll dive into the essentials of saving money, simple strategies to start saving today, and why even the smallest steps can completely transform your financial future. See you in the next video.
Hey everyone, welcome back to our course, Financial Literacy from Scratch. In the previous video, we talked about the basics of financial literacy and budgeting. If you haven't seen that video yet, the link will pop up in the top corner, or you can also find it in the description box below. Today, we're diving into one of the most powerful, yet often misunderstood, parts of personal finance, saving money. Now, before you roll your eyes and think, oh no, another boring lecture telling me to stop buying coffee, let me stop you right there. This is not about guilt or restriction. This is about empowerment. Because here's the truth, saving isn't just a financial habit. It's a complete mindset shift. Once you master it, you'll see it's not about deprivation at all. It's about freedom, control, and possibilities. In this video, you'll discover why saving matters way more than you think, and the psychology behind it. How even the tiniest amounts can trigger a powerful snowball effect. Smart saving strategies even when your income feels too low. The number one mistake almost everyone makes with savings, and how to avoid it. Simple ways to keep your savings safe from hidden risks. The surprising perks of saving money that no one talks about. So grab a notebook, because this one might just change the way you see money forever. Part 1. Why saving is important. Psychology of saving. Let's start with a question. Why do you even need to save? Most people say, well, for emergencies, or so I don't run out of money. Sure, that's true, but that's not the whole story. Here's the real deal. Saving builds security and confidence. Think about it. When you have money saved up, even a small emergency fund, you instantly feel safer. You don't panic when your car breaks down, when you lose your job, or when unexpected bills arrive. You know you've got a cushion. But there's also a psychological effect. Savings create mental freedom. Instead of constantly worrying, what if, you live with peace of mind. It also creates momentum. Every time you put money aside, no matter how small, your brain gets a hit of dopamine. You feel accomplished, and that motivates you to keep going. In fact, studies show that people with even $500 saved feel dramatically less financial stress than people with zero savings. It's not the amount, it's the sense of security. So saving isn't about being rich or poor. It's about creating stability. And stability is the foundation for everything else. Investing, starting a business, buying a home, even just sleeping well at night. Part 2. The snowball effect of small amounts. Now, let's tackle one of the biggest myths. I can't save because I don't earn enough. What's $5 going to do? The truth is, small amounts matter more than you think. Imagine this. You save just $5 a day. That's one coffee, one snack, one small expense. In a month, that's $150. In a year, it's $1,800. Now, let's add interest or investing. If you put that $5 a day into an account earning 5% annually over 10 years, you'll have over $23,000 from just coffee money. That's the snowball effect. Small amounts, consistently saved, roll into something massive over time. And here's where the psychology kicks in again. When you see your savings grow, you want to save more. You start thinking twice before spending. Suddenly, $5 doesn't feel useless. It feels powerful. The key isn't starting big. The key is starting small, but never stopping. Part 3. How to save on a low income. Now, let's address the elephant in the room. That's great, but what if my income is low? What if I can barely cover rent and food? I hear you. And this is real. Many people struggle with this. But here's the secret. Saving is still possible, even on a small income. Here are 3 strategies. 1. Save first, spend later. Most people spend, then see what's left over to save. But on a low income, there's usually nothing left. Flip it. Even if it's $10 a week, set it aside first, as if it's a bill. Pay yourself like you pay rent. 2. Automate your savings. If you wait until you feel ready, you'll never do it. Set up an automatic transfer on payday, even if it's just $20. Out of sight, out of mind. And your savings quietly grow. 3. Cut with creativity, not sacrifice. This doesn't mean living miserably. It means finding smarter swaps. Cook at home 3 nights instead of ordering takeout. Cancel subscriptions you barely use. Buy secondhand for things like clothes or furniture. Each change is small, but together they free up money. And here's the thing. It's not the amount that matters. It's the habit. If you prove to yourself that you can save $5, you've built the muscle. And once you earn more, that muscle grows stronger. Many wealthy people today started this exact way. They didn't wait until they made more money. They learned to save on little, which is why they now manage a lot. Part 4. The number one mistake in saving. Let's talk about the biggest mistake people make when it comes to saving money. Here it is. Saving only what's left over. Think about it. After rent, food, bills, and a bit of fun, what's usually left? Nothing. And even if there is, life has a funny way of making that extra money disappear. A sudden dinner, a new gadget, an impulse buy. That's why people live paycheck to paycheck, even when they make good money. Because savings are an afterthought. The fix? Make saving the first priority. Treat it like rent. Treat it like your phone bill. Treat it like a non-negotiable, even if it's just $20 a month. The discipline is worth more than the amount. Because here's the secret. If you don't control your money will control you. Part 5. Protecting your savings. Now, there's one more crucial piece we need to talk about. Protecting your savings. See, it's not enough to just build savings. You also need to make sure they don't disappear the moment life throws you a curveball. Here's what I mean. Plan for irregular expenses. Things like car repairs, medical bills, annual insurance, or even holiday spending. If you don't include them in your budget, when they hit, they can wipe out your savings in one go. That's why it's important to set aside money for these expected surprises every single month. Think of it as a sinking fund, a small pot you regularly contribute to, so when these costs show up, you're ready. Avoid draining your savings for big purchases. Another common mistake is finally building up a cushion, say $1,000 or $2,000, and then spending it all at once on a new phone, furniture, or even a vacation. This destroys the habit and resets your progress. Instead, if you have a big purchase in mind, create a separate fund for it. This is where the 50-30-20 rule can help. Remember, 50% of income needs, rent, food, bills. 30% wants, fun, lifestyle. 20% savings. If you're planning for a major purchase, you can take a small part of that 20%, or even add an extra 5% just for that specific goal, without touching your emergency savings. Give your money a job. Savings without a clear purpose tend to get spent impulsively. But when you label your accounts, emergency fund, vacation fund, new car, future home, you're less likely to dip into the wrong one. So remember, building savings is step 1, but protecting them is step 2. Without protection, you're stuck in a cycle of starting over again and again. With protection, your savings become the foundation for your financial growth. Part 6. The hidden perks of saving money. Most people think of savings as something boring, just money sitting in your account. But in reality, your savings unlock some surprisingly powerful benefits. A safety cushion. Life can be unpredictable. Losing a job or facing sudden expenses is stressful, unless you have savings. Experts recommend keeping enough to cover 5 to 6 months of your essential expenses, or even 5 to 6 full salaries, if possible. This cushion gives you peace of mind and the freedom to make better decisions without panic. Savings attract more money. Think of savings like a magnet. When you have money set aside, you feel more confident, make smarter financial moves, and new opportunities naturally start showing up. It's as if money likes to flow where it's already respected. A gateway to investments. Savings are not just for keeping. They're the foundation for growing your wealth. Once you've built your safety net, those savings can be transformed into investments. And that's where your money starts working for you. We'll dive deeper into investments later in this series. So, let's recap. Saving is not just about money. It's about security, freedom, and peace of mind. Small amounts snowball into life-changing sums over time. You can save even on a low income by flipping the script and saving first. And the number one mistake: waiting to save what's left over. Protect your savings by planning for irregular expenses and avoiding the trap of draining them on big purchases. Savings create a safety cushion, attract new opportunities, and open the door to investing. Remember, saving isn't about being perfect. It's about progress. It's about building a habit today that your future self will thank you for. So, here's your challenge. Start today. Even if it's $1, even if it's coins in a jar. The habit is the victory. If this video inspired you, make sure to hit like, subscribe, and share it with someone who needs that little push to start saving. And we'll keep this journey going in our series, Financial Literacy from Scratch. Until then, start small, stay consistent, and watch your future transform. See you in the next video. Welcome back to Financial Literacy from Scratch. Today, we're tackling a big question. Where should you keep your money? For many people, a bank account is just a card they swipe or a place their salary lands. But once you dig deeper, you realize that the kind of account you choose, and even the bank you choose, can make a huge difference in your financial life. Checking, savings, online versus traditional banks. At first it sounds complicated, but don't worry. Once you understand the basics, you'll see it's actually pretty simple. And by the end of this video, you'll know how to pick the best setup for your money. Part 1. Checking versus savings accounts. Let's start with the foundation. Checking accounts versus savings accounts. A checking account is your everyday money hub. It's where your paycheck usually gets deposited. It's the account you use to pay bills, shop online, and swipe your debit card. Think of it as your wallet in digital form. Money flows in, money flows out. A savings account, on the other hand, is not for everyday spending. It's designed for money you want to set aside. You earn some interest, not huge, but better than nothing. It's your first step toward building an emergency fund or saving for goals. Here's a simple way to picture it. Checking is your day-to-day backpack, while savings is your locked treasure chest. Now, some people make a big mistake. They mix everything in checking. The problem? When your spending and saving are in the same pot, it's too easy to overspend. That's why keeping these two accounts separate is one of the smartest moves you can make. Part 2. How to choose the right bank. Okay, so you know the types. But where should you actually open your account? Not all banks are created equal. Some are friendly, some are fee traps. Here's what to look at. Fees. Does the bank charge you just for holding an account? Monthly maintenance fees, overdraft charges, minimum balance requirements. These can quietly eat away at your money. Security. In the US, you want FDIC insurance, which protects deposits up to $250,000. In Canada, it's CDIC insurance, which covers $100,000. Always make sure your money is protected. Convenience. How easy is it to access your money? Does the bank have nearby ATMs, a good mobile app, 24/7 customer support? The best bank is not always the biggest or most famous one. It's the one that helps you keep more of your money and makes your financial life easier. Imagine two people, Sarah and Mike. Sarah chose a flashy big-name bank but pays $15 every month in fees. That's $180 a year gone. For nothing. Mike picked a no-fee online bank and saves that $180, which he puts into his savings account instead. Same income, different choices. And in the long run, Mike is way ahead. Part 3. Avoiding hidden fees. Let's be real. Banks love fees. Here are the most common traps. Monthly maintenance fees if your balance drops below a certain number. Here's one fee that surprises a lot of people. Monthly maintenance fees. Some banks actually charge you just for keeping your account open. But here's the catch. You can often avoid the fee if you keep a certain minimum balance. Example. A big bank might charge you $12 every month unless you always keep at least $1,500 in your checking account. If your balance drops below that, boom, you pay the fee. Now think about it. $12 every month is $144 a year. Money gone for nothing. Tip: if you don't want to waste money, you have two options. Look for banks that offer no-fee accounts. Many online banks and credit unions do this. Or make sure you always keep the required minimum balance. So before opening an account, always check: is there a monthly fee? And what's the balance requirement to avoid it? Overdraft fees if you spend even $1 more than what's in your account. Another common trap in banking is the overdraft fee. This happens when you spend more money than you actually have in your checking account. Even if it's just by one single dollar, the bank will often step in, cover the transaction, and then charge you a fee for it. For example, imagine you have $50 in your checking account, but you swipe your debit card for $55 at the grocery store. The bank approves the payment, but then hits you with an overdraft fee, usually around $30 to $35. So your $55 purchase just cost you $85 to $90 in total. And it doesn't stop there. If you make multiple transactions while your account is negative, some banks charge you a separate overdraft fee for each one. That can quickly snowball into hundreds of dollars in penalties. How to avoid overdraft fees? Always keep an eye on your balance. Turn off overdraft protection if you'd rather have your card declined than pay a $35 fee. Link your checking to a savings account. That way, money can transfer automatically if you overspend. Or choose a bank that offers no overdraft fees. Many online banks now do. So remember, overdraft fees are not just a small penalty. They can drain your money faster than you think. A little awareness goes a long way in keeping your hard-earned cash safe. ATM fees for withdrawing cash at another bank's machine. Another sneaky fee to watch out for is ATM fees. If you use an ATM that doesn't belong to your bank, you often get charged twice, once by your own bank and once by the ATM's bank. That $20 cash withdrawal? It could cost you $23 or even $25. So always look for your own bank's ATMs, or choose a bank that refunds out-of-network ATM fees. Transfer fees for moving your own money. Some banks even charge transfer fees, just for moving your own money between accounts. For example, sending money from your checking to savings or wiring funds to another bank. It's your money, but they still take a cut. Tip: look for banks that offer free transfers. Now that you know the most common bank fees, let's wrap up with the main ways to protect yourself. 1. Always read the fine print before opening an account. 2. Don't be afraid to switch banks. Loyalty doesn't pay here. You should choose the bank, not the other way around. 3. Set up alerts in your mobile banking app. Many banks let you get a text if your balance drops below a certain point. That way, you don't get caught by surprise. Here's the truth. Banks make billions every year from customers who don't pay attention. Don't be one of them. Part 4. Online banks versus traditional banks. Now, the big debate. Should you use an online bank or a traditional one? Traditional banks. Physical branches. You can walk in and talk to a teller. Cash deposits are easy. Many people trust them because they've been around forever. Online banks usually offer higher interest rates on savings, fewer or no monthly fees, super convenient apps and online tools. But no physical branch. You can't just walk in and speak to someone. Here's the modern solution most smart people use: a mix of both. Checking account with a traditional bank for quick access and convenience. Savings account with an online bank to earn higher interest and pay fewer fees. That way, you get the best of both worlds. So, where should you keep your money? Your checking account is for daily life. Your savings account is for building your future. And the right bank is the one that protects your money, avoids fees, and works for you. Remember, money sitting in the wrong place is money that's slowly leaking away. But money sitting in the right place is money that grows and gives you freedom. In the next part of Financial Literacy from Scratch, we'll dive into a whole new side of money: credit, debt, and how to use it wisely. Until then, choose wisely. save smart, and keep your money working for you. See you in the next video. Hey everyone, welcome back. Today's topic is one that can make or break your financial future: debt and credit. Here's the truth: debt isn't automatically bad. In fact, it can either help you build wealth or hold you back for decades. It all depends on how you understand it and how you use it. By the end of this video, you'll know what credit really is, how credit cards actually work, the difference between good debt and bad debt, and how to protect your credit score so you don't fall into the trap. So grab a notebook, because these are the kinds of lessons that can save you thousands of dollars over your lifetime. Quick note before we jump in: this isn't a lecture, it's a toolkit. I'll give real examples, real numbers, and simple actions you can take today. If you keep your phone close, pause the video and set a 5-minute reminder to check one thing after we finish. That small action can make a big difference. Part 1. What credit really is. Alright, let's start at the beginning. What is credit? Credit is simply trust with money. A bank, a credit union, or even a store says, "We'll let you take this money now, because we trust you'll pay us back later." But here's the catch. You're not just paying back what you borrowed. You're paying back more because of interest. Example: if you borrow $1,000 with a 20% annual interest rate and you don't pay it back right away, you could owe $1,200 at the end of the year. And if you only pay the minimum, that $1,000 could drag out for years and cost you $2,000 or more. Think of credit like a tool, a hammer, for example. Use it properly and you can build a house. Use it recklessly and you can smash a window. Credit is no different. It can either build your future or destroy it. Quick question for you in the comments. When you first got access to credit, maybe your first card or loan, did you use it wisely or did you fall into the trap? I'd love to hear your stories. A couple of quick terms to keep in mind. Principal equals the amount you borrow. Interest equals the price you pay to borrow it. APR equals annual percentage rate. The real annual cost of borrowing once fees are included. Interest can be calculated daily and compounded, which is why carrying a balance even for a month matters. Small differences in APR add up fast, so when you compare loans, look at APR, not just the headline rate. Part 2. How credit cards work. Let's move on to credit cards, because this is where most people get caught. When you swipe your card, the bank is paying for you. At the end of the month, you have two choices: pay them back in full, no problem, no interest. OR paid just a little bit, called the minimum payment. And that's where trouble begins. Why? Because the bank starts charging interest, often 15%, 20%, sometimes even 30%. Example: imagine you buy a $500 phone on your credit card. You only pay $25 a month. Sounds easy, right? Well, with interest, that phone could end up costing you $700 or $800 by the time you're done. That's the trap. Credit cards are convenient, but they're designed to make banks money. On the flip side, if you use them wisely, they actually come with huge perks. Many cards give you cash back: 1%, 2%, sometimes 5% on certain purchases. Travel cards offer points and miles that can cover flights or hotel stays. Some cards even give purchase protection or extended warranties. Example: imagine spending $1,000 on your card and getting 2% cash back. That's $20 for free, as long as you pay the balance in full and avoid interest. Over a year, this could add up to hundreds of dollars in rewards. Part 3. Good debt versus bad debt. Now here's the big question. Is all debt bad? Surprisingly, no. Let's break it down. Good debt. This is debt that helps you grow financially or improves your future. Student loans, when used wisely, can increase your earning power. Mortgages help you own property, which usually grows in value. Business loans can help you generate income. In these cases, the debt is like an investment. You're borrowing today to build something better tomorrow. Bad debt. This is the debt that keeps you stuck. high-interest credit card balances, payday loans with crazy fees, borrowing to buy luxury items you can't actually afford. This kind of debt doesn't create value. It just takes your money and locks you into a cycle. Story: I once read about a guy who financed a $5,000 vacation with his credit card. By the time he paid it off, he had spent over $9,000. And guess what? The vacation was long gone. But the debt stuck around. That's the danger of bad debt. So remember, good debt equals builds your future. Bad debt equals steals from it. Part 4. Building and maintaining a healthy credit score. Now, let's talk about something most people ignore until it's too late: your credit score. Think of it like your financial report card. It shows lenders how trustworthy you are, and it affects everything. Whether you get approved for a loan, the interest rate you pay, even things like renting an apartment or applying for certain jobs. So, how do you protect it? Always pay bills on time. Even one late payment can drag your score down. Keep credit card balances low, ideally under 30% of your limit. Don't open too many new accounts at once. Use credit regularly, but never max it out. Here's the kicker: a good credit score can literally save you tens of thousands of dollars over your lifetime because you'll pay lower interest rates. Example: let's say two people buy the same $200,000 house. Person A has excellent credit and gets a 6% mortgage. Over 30 years, they'll pay about $232,000 in interest. Person B has poor credit and gets an 8.5% mortgage. Over 30 years, they'll pay about $353,000 in interest. That's a difference of more than $120,000, just because of their credit score. So, how is your credit score actually calculated? Think of it like a recipe with different ingredients adding up to your score. The biggest piece, about 35%, is your payment history. Do you pay your bills on time? Even one late payment can hurt. Next, around 30% is your credit utilization. That just means how much of your credit limit you're using. Under 30% is the sweet spot. About 15% comes from the age of your accounts. The longer you've had credit, the better. Around 10% is new credit. If you apply for too many cards or loans at once, your score can dip. And the last 10% is your credit mix. Lenders like to see you can handle different types of credit, like a credit card, revolving, and a car loan or mortgage installment. Add all of that together and you get your credit score, your financial report card. So let's wrap it up. Credit is a tool. Use it wisely. Credit cards are powerful but dangerous if you carry a balance. Good debt builds your future. Bad debt traps you in the past. Protect your credit score because it's one of your most valuable financial assets. Debt doesn't have to be scary. With the right knowledge, it can be a stepping stone instead of a stumbling block. Now, I want to hear from you. Do you believe there's such a thing as good debt? Or do you think all debt is bad? Drop your thoughts in the comments. I'll be reading them. Don't forget to like, subscribe, and share this video with someone who needs to understand the truth about credit. Together, let's build financial freedom, step by step. Quick checklist you can use after this video. Check one credit account right now. Review balance and due date. Set up autopay for at least the minimum on one card. Calculate your credit utilization, balances divided by limits, and aim for under 30%. If you carry high-interest card debt, list all balances and pick an avalanche or snowball plan. If you're building credit, consider a secured card or ask a trusted family member to add you as an authorized user, only if they're responsible. That's it. Small steps, big impact. See you in the next video. And remember, control your credit. Don't let it control you. Hey everyone, welcome back to the channel. Let me ask you a simple question. Have you ever looked at your bank account at the end of the month and thought, wait, where did all my money go? Maybe you didn't buy anything huge, no new car, no giant TV, but somehow, little by little, the money just disappeared. If that sounds familiar, this video is for you. Today, we're talking about smart spending. Not about living like a monk. Not about cutting out every coffee or every little joy. Instead, this is about learning how to stop wasting money on things that don't matter, so you can spend more on the things that actually bring you happiness and move you toward your goals. By the end of this video, you'll understand how emotional spending traps keep you broke, how social media and trends trick you into buying things you don't need, why minimalism isn't the only answer, and what smart consumption looks like. 3 simple questions to ask before every purchase. Why budgeting is your secret weapon, with the 50-30-20 rule and planning for irregular expenses, the hidden trap of lifestyle inflation, and how to avoid it. And finally, how to practice mindful spending so you enjoy life without guilt. This video could literally save you thousands of dollars every year, so grab a notebook because you're going to want to remember these tips. Part 1. Emotional spending traps. Let's start with emotional spending. We've all been there. You're stressed after a long week and you think, I deserve a treat. Maybe it's new clothes, maybe it's ordering takeout, maybe it's gadgets you don't really need. This is what's often called retail therapy. And it works. Temporarily. You feel good in the moment. But here's the problem. That feeling fades in hours, sometimes even minutes. What doesn't fade? The bill. Example. Imagine someone who spends just $60 a week on little treats. That doesn't sound like much, right? But multiply it by a year. That's over $3,000 gone. And most of the stuff they bought doesn't add real value to their life. The psychology here is simple. Our brain releases dopamine when we buy something new. It feels like a reward. But just like junk food, the high is temporary, and then you crave more. So, what's the solution? Instead of cutting out every joy, identify your triggers. Do you shop when you're stressed, when you're bored, when you feel left out? Once you know the trigger, you can replace it with something else. A walk, a hobby, calling a friend, even journaling. Quick question for you. What's your personal trigger for impulse spending? Drop it in the comments. I bet you're not alone. Part 2. Social media and trend spending. Now let's talk about one of the biggest spending traps today. Social media and trends. Have you ever scrolled TikTok, Instagram, or YouTube and suddenly thought, wow, I need that? Maybe it's a gadget, a skincare product, or clothes that everyone's showing off. That's not really need. That's influencer marketing working exactly as designed. Brands know that when you see someone relatable or stylish using a product, your brain connects it with belonging, status, or even happiness. The danger? You end up buying things just because they're trending. And trends move fast. A month later, the product is forgotten, but the money is gone. Here's a classic example. Remember the hype around fidget spinners? Millions of people bought them because of trend pressure. A few months later, they were in drawers or trash bins. That's the power of social media-driven consumption. Here's a trick. If you see something online and suddenly want it, pause for 48 hours. Ask yourself, would I want this if I hadn't seen it in that video? If the answer is no, you just saved yourself money. Question for you. What's the last thing you bought just because you saw it online? Did it really add long-term value to your life? Be honest, we've all been there. Part 3. Minimalism versus smart consumption. Some people hear advice like this and think, so the solution is minimalism. Own nothing, cut out coffee, live in an empty room. Not necessarily. For most people, extreme minimalism isn't realistic or enjoyable. And money is also meant to be enjoyed. The better approach is smart consumption. Smart consumption means buying less, but better. Instead of 5 cheap t-shirts, buy 2 high-quality ones that last longer. Instead of eating out randomly 3 times a week, save it for a special occasion and actually enjoy it more. It's not about depriving yourself. It's about cutting the waste so you can keep the joy. Mini exercise. Think of one area where you overspend without even enjoying it. Maybe subscription services you don't use. Maybe random Amazon buys. If you cut just that category, how much would you save every month? Part 4. 3 questions before every purchase. Now, let's get practical. Here are 3 questions you should ask before every purchase. 1. Do I really need this? Or do I just want it right now? 2. Will I still care about this in 30 days? 3. Does this purchase help me reach my bigger goals? Example, you're tempted to buy $200 headphones. Your old ones still work. In 30 days, you probably won't care. Bigger goal? Maybe saving for travel or paying down debt? Suddenly, the answer is clear. Skip it. This simple test can save you from hundreds of regret purchases every year. Part 5. Budgeting. Your secret weapon. Now, let's connect this with something we've already discussed on this channel. Remember our video on budgeting basics? If you missed it, check the link in the description. It's a must-watch if you want control over your money. Here's the truth. Budgeting is the foundation of smart spending. Without it, money slips through your fingers like water. You might think you're doing fine, but at the end of the month, you look at your account and wonder, where did it all go? That's why a budget is not about restriction. It's about freedom. It gives you a clear plan so you can spend on the things you love, without guilt, while still protecting your financial future. One of the simplest and most powerful methods is the 50-30-20 rule. 50% for needs, rent, utilities, groceries, transportation. 30% for wants, dining out, streaming services, shopping, travel. Basically, your lifestyle fund money. 20% for savings and debt repayment, building your emergency fund, investing, paying down credit cards or loans. My recommendation, use this rule as your anchor. It's flexible. You can adjust based on your income or priorities, but it keeps you balanced. It makes sure you're enjoying life now and building security for the future. And let's add a crucial point we covered in the Saving Money episode. Protect your savings by planning for irregular expenses. These are the sneaky costs that don't show up every month but always show up eventually. Annual car insurance, unexpected medical bills, car maintenance, home repairs, holiday gifts, birthdays, and vacations. If you don't plan for them, they'll feel like emergencies every single time. And what happens when you're unprepared? You swipe the credit card, go into debt, and undo your hard work. A simple trick. Create sinking funds. That means putting aside a little bit each month for those irregular expenses. For example, if you know car insurance costs $600 per year, save $50 each month into a separate account. By the time the bill comes, you're ready. No stress, no debt. Another pro tip, when your income increases, resist the temptation to inflate your lifestyle. Instead of spending more, keep your needs and wants within the same range, and funnel that extra money into savings and investments. This is how real wealth builds over time. Remember, a budget isn't there to limit you. It's there to make sure your money works for you instead of disappearing. With a budget, you control your spending instead of letting your spending control you. Part 6. Lifestyle Inflation Trap. Now let's talk about a sneaky trap that hits almost everyone. Lifestyle inflation. Here's how it works. You get a raise. Great. Instead of saving more, you upgrade your lifestyle. You move to a bigger apartment. You buy a nicer car. You eat out more often. You add subscriptions. And suddenly, your expenses match your new income. You're making more money, but you don't feel any richer. This is why some people making $100,000 a year feel just as broke as when they made $40,000. Their lifestyle grew, but their savings didn't. Solution: every time your income increases, commit a portion to savings or investing before upgrading your lifestyle. That way, your raises actually build wealth, instead of just funding more stuff. Question for you. Be honest. When your income goes up, what's the first thing you tend to spend more on? Part 7. Mindful spending and psychology of consumption. Finally, let's talk about mindful spending. Mindful spending doesn't mean cutting everything. It means being aware of why you're spending. It means choosing purchases that align with your values and long-term goals. Here's how it works. Write down 3 things you love spending on. Things that bring you joy or lasting value. Maybe travel, hobbies, experiences. Now write down 3 things you often spend on but don't really care about. Maybe impulse snacks, random apps, extra clothes. The trick? Cut the second list, double down on the first. This way, you don't feel deprived. You feel in control. You get to enjoy life, but also watch your savings grow. And here's something powerful. When your spending matches your values, your money brings more happiness per dollar. That's the opposite of emotional or trend-driven buying, where the happiness fades instantly. So ask yourself, does this purchase make me happy now and help me build the life I want in the future? Let's recap everything we covered. Emotional spending gives short-term joy, but long-term regret. Social media and trends push you to buy what you don't need. Smart consumption beats extreme minimalism. The 3-question test helps you avoid regret. Budgeting is your secret weapon. Use the 50-30-20 rule and plan for irregular expenses. Lifestyle inflation makes you spend more as you earn more, instead of saving the extra. And mindful spending lets you enjoy life while still building wealth. Now, I'd love to hear from you. What's one purchase you regret? And one purchase you'll never regret because it was worth every penny. Drop it in the comments below. If you found this video helpful, don't forget to hit like, subscribe, and share this with someone who keeps saying, "I'm broke," but shops online every day. Thanks for watching, and I'll see you in the next video, where we'll cover the basics of investing and how to make your money grow. Hey everyone, welcome back to the channel. Here, we're learning about money, step by step, in simple, everyday language. No complex finance terms, no pressure. Just real lessons to help you build financial confidence from scratch. Now, let me ask you something. You work hard for your money, right? But what if your money could start working for you, even while you sleep? That's the power of investing. In today's video, we're breaking down investing for beginners. No confusing jargon, no fancy Wall Street terms. Just real talk about how to make your money work for you, even if you're just getting started. Because here's the truth, saving money is important, but saving alone won't make you rich. Investing is what turns your savings into real growth over time. By the end of this video, you'll understand why saving alone isn't enough, what stocks, bonds, and funds actually are, the power of compound interest, your best financial friend, common investing myths, and what's actually true, the biggest mistakes beginners make, and how to avoid them, how to start investing step by step, how much you should invest, even if you're on a small budget, how to spot and avoid scams that target beginners, how to build a strong, confident investor mindset, other types of investments, from real estate to crypto and beyond. So grab a coffee, hit that like button, and let's make your money start working for you. Part 1. Why saving alone isn't enough. Let's start with this question. If you save $10,000 in a bank account, what happens after 1 year? Most banks today offer an interest rate of around 0.1% to 1%. That means after a year, you might earn $10 or $100. Not bad, right? Well, except for one problem. Inflation. Inflation means prices rise over time. If inflation is 4% per year and your money grows only 1%, you're actually losing 3% of your purchasing power. Inflation rates vary. Check local CPI. So saving is safe, but it won't make you rich. Think of saving like keeping seeds in a jar. They're protected, yes, but they'll never grow. Investing is planting those seeds, letting them grow into trees that produce fruit year after year. That's why we say, saving protects your money. Investing multiplies it. Part 2. What investing really means. Investing simply means using your money to buy something that can grow in value or generate income over time. There are many ways to invest, but the most common and beginner-friendly are stocks, bonds, and funds. Let's break these down simply. Stocks. When you buy a stock, you're buying a small piece of a company. If that company grows, the value of your share grows too. And sometimes you even get paid dividends, a small share of the company's profits. Bonds. Think of bonds as loans. You lend your money to a government or a company, and they pay you back later, with interest. Bonds are generally safer, but the returns are lower compared to stocks. Funds. Funds are baskets that hold many different investments. Instead of buying one company's stock, you buy a mix of many, which lowers your risk. Two popular types are mutual funds and index funds. Index funds are especially great for beginners. They track the overall market, S&P 500, MSCI World, local indices. Choose a broad, low-cost fund that matches your goals. That means you don't have to guess which stock will win. You invest in the entire economy. Part 3. The power of compound interest. Now, let's talk about the magic behind investing. Compound interest. Albert Einstein once called it the eighth wonder of the world. Here's why. Let's say you invest $1,000 at a 10% annual return. After 1 year, you earn $100 in profit. That's your interest. Next year, you don't just earn on your original $1,000, you earn on $1,100. Your interest earns interest. That's compounding. And over time, it's unstoppable. If you invest $200 per month starting at age 25, by the time you're 55, assuming an average 8% return, you'd have $298,000. But if you wait until 35 to start, you'll end up with $180,000 less, even though you invested only $24,000 less. The earlier you start, the more time your money has to grow. Time is your most powerful investment tool. Part 4. Common investing myths. A lot of beginners are scared of investing. They think, I need a lot of money to start, or it's too risky, I might lose everything. Let's bust those myths. Myth number 1. You need thousands of dollars to invest. Nope. Today, you can start with as little as $10 using investing apps or online brokers. Myth number 2. Investing is gambling. Wrong again. Gambling is based on luck. Investing is based on time, discipline, and diversification. Myth number 3. I'll just wait until I have more money. Big mistake. Waiting costs you time, and time is compound interest's best friend. So start small, start early, and stay consistent. Part 5. Mistakes beginner investors must avoid. Let's talk about the traps that cost beginners thousands. Mistake number 1. Trying to time the market. Even professional investors can't predict market ups and downs perfectly. It's better to stay in the market consistently than to try to time it. Mistake number 2. Putting all your money into one stock. That's risky. Diversify. Spread your investments across different companies and industries. Mistake number 3. Panic selling. When the market drops, beginners panic and sell. Historically, broad markets have recovered over long horizons, but recovery timing varies. Invest with a long-term horizon. You can weather short-term drops. The biggest investors make money because they stay calm when everyone else panics. Mistake number 4. Ignoring fees. Some mutual funds charge high fees that eat into your returns. Look for low-cost index funds instead. And most importantly, invest only money you don't need right away. The stock market rewards patience, not panic. Part 6. How to start investing. So how do you actually start? Here's a simple 5-step plan for beginners. 1. Build your emergency fund first. You need savings for unexpected expenses, usually 3 to 6 months of living costs. 2. Pay off high-interest debt. No investment beats paying off credit cards charging 20% interest. 3. Open an investment account. This can be through your bank, a brokerage app, or even a retirement account like a 401k or IRA. 4. Choose low-cost, diversified funds. Index funds or ETFs are ideal. They give you instant diversification. 5. Automate your investments. Set a fixed amount each month and forget about it. That's how you build wealth on autopilot. Part 7. How much should you invest? This is one of the most common questions, and the answer depends on your income, expenses, and goals. But here's a simple rule that works for most people. Start with 10 to 15% of your income. If you can only start with 5%, that's fine. The key is to start and be consistent. Here's how it fits into your budget. Use the 50-30-20 rule as your base. 50% for needs, 30% for wants, 20% for savings and investments. As your income grows, try not to increase your lifestyle spending proportionally. Instead, increase your investment percentage. That's how wealth builds quietly in the background. If you already have high-interest debt, focus on paying that down first before you invest heavily. Because if your credit card charges 20% interest and your investment earns 7%, you're still losing money overall. Golden rule: never invest money you can't afford to leave untouched for several years. Investing is for the long term, not for quick profits. Part 8. How to avoid scams and fake investment opportunities. Unfortunately, where there's money, there are scammers. New investors are often targeted with fake, too good to be true opportunities. Here's how to protect yourself. If someone promises guaranteed returns, it's a scam. Real investments always carry risk. Never invest in something you don't understand. If you can't explain it simply, don't put money in it. Avoid unlicensed platforms or individuals. Only use regulated brokers and funds. Be cautious with crypto projects and MLM schemes. Many are just modern versions of Ponzi schemes. Check reviews and official registrations before transferring money anywhere. And remember, if it sounds too good to be true, it almost always is. Part 9. Building an investor mindset. Investing isn't just about numbers, it's about mindset. Patience, discipline, and emotional control matter more than market knowledge. Don't compare your results to others on social media. Most people only show their wins, not their losses. Real investors play the long game. They don't panic when prices drop or brag when they rise. Set clear goals. What are you investing for? Financial freedom, retirement, a home, your children's education. How long can you keep your money invested? When you know your why, you'll stay calm through market ups and downs. Part 10. Other types of investments. Now that you understand the basics, stocks, bonds, and funds, let's explore a few other types of investments you'll hear about as you continue your financial journey. These aren't always beginner-friendly, but it's good to know what's out there. 1. Real estate. Owning property is one of the oldest and most proven forms of investing. You can make money in 2 ways. Appreciation, when your property value increases over time. Cash flow, when you rent it out and earn monthly income. But real estate isn't easy money. You'll need capital, patience, and the ability to deal with maintenance costs, taxes, and sometimes tenants who don't pay on time. Still, it can be a great way to diversify once your finances are stable. 2. Index funds and ETFs. We already mentioned mutual funds, but ETFs, exchange-traded funds, deserve a special note. They're like baskets of many companies' stocks, giving you instant diversification. But they trade like regular stocks. Think of it as buying a tiny slice of hundreds of companies at once. Cheaper and safer than picking one. 3. Retirement accounts. Depending on where you live, you may have access to tax-advantaged accounts like a 401k or IRA in the US. They allow your money to grow tax-free or tax-deferred, which means more of your earnings stay invested. The earlier you start, the more powerful the compounding becomes. Even small contributions now can turn into thousands later. 4. Commodities. These include things like gold, oil, or agricultural goods. Some people buy them as a hedge, to protect their money when the stock market falls or inflation rises. But they're very volatile and not always ideal for beginners. 5. Crypto and digital assets. Yes, we have to mention it. Cryptocurrency. It's a new, high-risk market. Prices can jump or crash overnight. If you ever invest in crypto, keep it as a very small percentage of your portfolio, and only money you can afford to lose. Never fall for hype or guaranteed returns. That's where scams love to hide. Let's recap. Saving protects your money. Investing multiplies it. Compound interest is your best friend. Diversification reduces risk. Patience builds real wealth. Start small, start early. Invest 10 to 20% wisely. Avoid too good offers. Think long-term. Stay calm. Explore other ways to invest. Here's the beauty of investing. Once you've set it up, it works quietly in the background. Your money earns money, and that money earns even more money. Every night you sleep, every weekend you rest, your investments keep growing. This is how ordinary people, not just the rich, build financial independence. They let time and compounding do the heavy lifting. If you're serious about making your money work for you, start small, start today, and stay consistent. Question for you. What's holding you back from investing right now? Let me know in the comments. I read everyone. And if you found this video helpful, hit like, subscribe, and check out the previous episodes. Budgeting basics, saving money, smart spending. Let's keep building your financial freedom, step by step. See you in the next video. Hey everyone, welcome back to the channel. Let me ask you something right away. Why do some people seem to attract money effortlessly, while others work twice as hard and still struggle to get ahead? It's not luck. It's not just intelligence. It's mindset, the way they think about money, opportunities, and success. Here's the truth. Wealth is not just about how much money you make or invest. It's about how you think about money, how you behave daily, the discipline you carry, and the long-term habits you build. In this video, you'll learn why 80% of financial success is psychology, the daily habits wealthy people use that you can adopt, how to build financial discipline so money doesn't slip through your fingers, how to think long-term and aim for financial independence. If you're ready to stop surviving and start thinking like the rich, stay with me till the end. This one might just change the way you see money forever. Part 1. Why 80% of financial success is psychology. Let's begin with a powerful idea. Money isn't the real obstacle. Mindset is. Many people focus on what they don't have: income, connections, opportunities. But the rich often emphasize something else: how they think about money. A popular rule among financial educators is 80% of success is emotional, psychological, and behavioral. Only 20% is knowledge or skill. What does that mean? It means you can know everything about investing, interest rates, tax shelters, but if your mindset is weak, you'll never fully apply it. Here are some mindset differences between average earners and wealthy thinkers. They see opportunities, not obstacles. They delay gratification rather than spending impulsively. They accept failures as lessons, not as permanent defeats. They control their emotions. They don't let fear or greed steer decisions. Question to you. Where do you feel your money mindset is stuck? Fear? Impulse buying? Worry? Drop it below. Awareness is the first step. Part 2. Daily habits of wealthy people. So, if mindset really shapes our financial reality, what exactly do wealthy people do differently every single day? Let's look closer at their habits, the small, consistent actions that quietly build empires over time. 1. They read and learn constantly. Wealthy people are lifelong students. They read books, analyze business news, listen to podcasts, study trends. Because the more you know, the more you see. Opportunities, risks, patterns others miss. They don't wait for someone to teach them. They take responsibility for their own growth. Knowledge compounds, just like money. 2. They plan their days and set priorities. Rich people don't just wake up and see how it goes. They start with clarity. What matters today, what can wait, and what moves them closer to their long-term vision. Every task connects to a bigger purpose: their business, investments, or personal goals. They understand if you don't run your day will run you. 3. They track their money. Always. No matter how much they earn, they know exactly where their money goes. They review expenses, budgets, investments regularly, not obsessively, but consciously. Because what gets measured gets managed. They treat money like a business partner, not a mystery. 4. They delay impulses. When temptation hits, a flashy gadget, a random sale, or emotional spending, they pause. They ask themselves, do I really need this? Will it still matter in 6 months? Does this move me closer to freedom or further away? That pause is powerful. It's where emotional control turns into financial growth. 5. They network and build real relationships. Wealth grows through people, not isolation. The rich surround themselves with other driven, curious, positive thinkers. They share ideas, collaborate, exchange opportunities. One conversation can open a door that changes everything, but only if you've built authentic connections along the way. 6. They manage energy, not just time. Money follows focus, and focus depends on energy. That's why many successful people protect their sleep, eat clean, and move daily. They know their mind is their main tool. You can't build wealth if you're constantly exhausted or burned out. Health is the foundation of every fortune. 7. They practice gratitude and reflection. This one might surprise you, but gratitude keeps ambition balanced. The wealthy often journal their wins, lessons, and moments of appreciation. They reflect not only on what went right, but on what they learned from what went wrong. That's how they stay grounded, humble, and emotionally resilient. You don't have to adopt all these habits overnight. Start small. Pick one or two that resonate with you. Practice them consistently until they become natural. Because wealth isn't built in a day. It's built every day. Part 3. Building financial discipline. Habits are great, but without discipline, they don't last. Discipline is what separates those who dream about wealth from those who actually build it. So, what is financial discipline? It's doing the smart thing with your money, even when you don't feel like it. It's saying not now to instant pleasure, so you can say yes later to financial freedom. Let's break down how to strengthen that muscle. 1. Automate your finances. Don't rely on willpower. It fades. Set up automatic transfers from your checking account to your savings or investment accounts right after payday. When saving and investing happen automatically, you remove emotion from the process. It's out of sight, out of mind. And it works. 2. Budget as your foundation. A solid budget isn't about restriction, it's about clarity. Use a simple rule like 50-30-20. 50% for needs, rent, bills, food. 30% for wants, fun, comfort, leisure. 20% for savings and investments. Knowing where your money goes gives you power, because you can't control what you don't track. 3. Track your fun money, but limit it. It's okay to enjoy your money. The trick is to decide in advance how much fun you can afford. Give yourself a guilt-free spending fund, and once it's gone, it's gone. This keeps your emotions in check and stops overspending before it starts. 4. Set clear financial goals. You can't stay disciplined without a why. Do you want to buy a home? Reach your first $100,000? Retire early? Whatever it is, define it, visualize it, and remind yourself often. When temptation hits, your goal becomes your shield. 5. Build accountability systems. Wealthy people rarely go it alone. They surround themselves with mentors, advisors, or financial communities that keep them accountable. Whether it's a money coach, an investing group, or a trusted partner, having someone who checks in on your goals keeps you focused and consistent. Discipline grows stronger when it's shared. 6. Measure success in progress, not perfection. You don't need to have perfect months. You just need better months. Small wins compound, just like money. If you stay consistent, your discipline will turn into a natural habit, and that's when the magic starts. Part 4. Long-term thinking and financial independence. Here's something almost every wealthy person understands. Getting rich isn't fast, it's exponential. Real wealth takes time, patience, and the right mindset. But the longer you think ahead, the more powerful your decisions become. Short-term pleasure versus long-term gain. Most people chase quick wins, a new phone, another trip, a flashier car. But rich thinkers play a different game. They ask, will this make my life better 5 years from now? If the answer is no, they pass. Because true success is delayed gratification, trading today's impulse for tomorrow's freedom. Think in decades, not days. Wealthy people don't measure progress by weeks or months. They think in years. They invest time, energy, and money into things that compound. Businesses, skills, assets, and relationships. When you think long-term, small steps don't feel small anymore. They're building blocks for the future. Ask yourself, what could my future self thank me for a year from now? The power of compounding isn't just for money. Yes, your investments grow over time, but so does your mindset, your knowledge, your habits. Every book you read, every skill you learn, every smart decision, it all compounds. The earlier you start, the bigger the impact. Financial independence isn't about quitting work. It's about freedom of choice. For many, financial independence sounds like retiring early and never working again. But the true goal is freedom. Freedom to choose the projects you want, the people you work with, the lifestyle you live. It's about having enough so money no longer controls your decisions. So here's the truth. Wealth doesn't start in your wallet. It starts in your mind. Let's recap what we've learned today. 80% of wealth comes from mindset, not math. Wealthy people read, plan, track, and learn every day. Discipline turns habits into results. Long-term thinking beats short-term comfort. Financial independence is freedom, not a number. Final takeaway: wealth isn't luck, it's alignment between your values, your goals, your habits, and your beliefs. When those line up, success follows naturally. Your challenge this week: ask yourself, what's one small habit I can start today that my future self will thank me for? Write it down. And that's it. The final episode of our Financial Literacy from Scratch series. But don't worry, it's not the last video on this channel. Your financial journey continues, and there's always more to learn, grow, and build. Here's a quick reminder of what we've covered: budgeting basics, saving money, smart spending, banking 101, debt and credit, investing for beginners, mindset of wealth. Each of these lessons builds on the other, so re-watch them when you need a reminder. And of course, if you found value in this video, give it a like, subscribe to the channel, and share it with someone who's ready to take control of their money too. Thank you for being part of this journey toward financial clarity and independence. This is just the beginning. Stay tuned for what's next. I'll see you in the next video. Take care, and keep growing your wealth mindset.